More bad news for anybody who is expecting a quick bailout, a return to quantitative easing from the Federal Reserve, as the Federal Reserve just got the green light to go big from job openings. As we know, job openings are the key measure that the Federal Reserve is looking at to know whether they have gone too far with tightening or whether they have further to go. And because more job openings just came out than what they expected, they got the green light to move faster on tightening. Ready? Let's dive in. Real quick, a word from today's sponsor, Swan Bitcoin. I use Swan Bitcoin to buy Bitcoin every single day. I dollar cost average, I stack sats. That means that as the price of Bitcoin is volatile and moving downwards, I'm getting my total overall position at a lower cost. I'm averaging down into it. The reason I use Swan Bitcoin is because we're looking around today, we're watching crypto exchanges lay people off. They're falling over like flies because they've all been not conservative. They've taken out leverage, but not so with Swan Bitcoin. They're extremely conservative, so I know that it's safe to use them. Because they only focus on Bitcoin, they're very efficient, very cheap, and the best part is they're extremely safe because your Bitcoin doesn't stay with them. You auto withdraw to a wallet of your choice whenever you want, and that's why I use Swan Bitcoin. And if you use my link in the description below, you will get $15 worth of Bitcoin just for signing up. If you're not aware, the Federal Reserve has two jobs and they're given to them by Congress. Just so you know, Federal Reserve only exists because Congress wants them to exist. The Federal Reserve Act of 1913 was written by Congress. They have two jobs. One of them is stable prices. The other one is full employment. Now, there's a little bit left up to them in terms of how to interpret those two things. Like prices, they interpret stable prices as moving up by 2% every year. I don't know about you, but for me, I would think stable prices would mean not moving up and not moving down. But for them, stable prices means moving up 2% every year. Now, we know over the last couple of years, prices have been moving up a lot more than 2% every year. And so they are being squeezed right now. They're at the end of the gun. People are telling them you need to get this inflation under control because that's one of your main jobs is to control prices. And they have not been able to get a handle on prices yet. So that is what they're focusing on. Now, on the other hand, they've got another job, which is maintaining full employment across the states. And full employment is at odds with stable prices because if you want to spur jobs to happen, you want more people to be employed, you're going to make conditions easy so that businesses will spend more money, invest more money, take out debt, hire more people. You want that growth environment, so you're going to make things easy. The problem is that causes inflation sometimes because more money being spent drives prices higher. So they're looking at prices and they know they need to get those prices down, and so they have to look at jobs, which is the other side of that coin, to see how much room they have. Well, they understand that jobs have not come back to where they were pre-pandemic. That's the labor force participation rate, has not come back. And so what they're looking at, instead of that measure, they're looking at job openings. Basically, they're saying, and this is understandable, they're saying, hey, if there are a lot of job openings, that's all we can do. We can only cause the conditions that will give companies the incentive to try and hire people. We can't actually force people to go get hired and go get those jobs. So as long as there are job openings, the Federal Reserve is saying the labor market is at full employment because there's tons of job openings per person who's unemployed. So as long as that's there, they have room to attack inflation. They have room to try and drive growth down, to stop growth, to make conditions tighter, harder, raise rates, sell assets off their balance sheet to try and bring prices down as long as full employment is still in place. And this surprise, you can see this chart from Bloomberg, we just got a surprise to the upside. US vacancies rose to 11.2 million in July, and June was revised upwards. And so you can see on this chart, this isn't the biggest bump, but it's certainly a tiny little reversal in the trend that we've been in for the last couple of months. So we could move down from here, and you know my opinion is the job indications that they look at are lagging. When you look at the leading indicators of jobs, especially like tech jobs, we're already seeing hiring freezes and layoffs start, and that's going to work its way throughout the rest of the economy at some point here. But as far as as the Fed is concerned, job openings are strongly suggesting they need to fight against inflation harder. What does this mean for you and I? It means we need to expect more tightening, more assets being sold off their balance sheet, more rate hikes. They're not slowing down. They're not intimidated by the recession. They're not intimidated by the stock market going down. They don't care about your 401k. They're going to try and slow down growth to cause a decline in growth, cause that recession to get deeper until those jobs dry up. Once the jobs dry up, once the layoffs start to happen for them to see, once the pain really sets in, then they're going to look and say, were we successful in stopping the inflation? And then at that point, we might see a pivot if the inflation has gone away. But the real problem will come in if they've gotten to the point where they're driving that unemployment, those layoffs are starting to happen, and we still have the inflation. Because at that point, then they truly have wedged themselves perfectly in between that rock and that hard place. Because if they go any tighter, they cause a massive collapse with unemployment and bankruptcies. And if they go any easier, they could cause hyperinflation. We'll see if it comes to that, but if it does, everybody will be watching and hanging on every word to figure out what the Federal Reserve will do. And as always, you know, I've got a course that teaches you how to bulletproof your portfolio. Whether we have hyperinflation, a deflationary death spiral, you need to be able to be protected, hedge yourself against those crazy events so that you know no matter what happens, you're not going to be vulnerable to any crisis that monetary policy makers can throw at you. Link for that course is in the description below. And as always, really appreciate you guys. Thank you so much for watching. Have a great day.